All right. Happy Friday. Welcome back to our 42nd Wook in Review. I'm Wook Capital Management Managing Director Rod Alsman. I am going to read a little disclaimer here as we get things started. Um, so, Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Now, it's funny, Joe, that this is the 42nd one. We've just got a lot of plays on that number coming up in the next several days. So
42.0 looking.
So yeah, it's 4:05 Eastern time. So for the handful of us listening, we will be publishing our PLBY-DD report in very short order. We are talking hours. We're still talking several dozen hours, but talking hours. So eager to publish that and give folks the opportunity to read it over the weekend. If you're looking at the screen, you can see I have a nice little printed out copy of it, several pages thick. So I look forward to seeing how that goes on Monday. We'll be hosting a discussion at some point in the day to kind of review the report in full, walk through kind of Q&A and see how that goes. I have an interview that'll be coming out next Thursday with Chit Chat Money on the topic, and I am going to be interviewing with the founder of Benzinga next week as well, so it'll probably be out a little bit thereafter. We'll talk a little bit about, for those who remember, I had the opportunity to go on Benzinga during January 21 a few times. They had me on when the stock was halted multiple times. It was a fun experience, so I'm sure we'll reminisce a little on that and talk about the journey that took me from there to where we are now with Wook Capital and what we're looking to do. So I'm eager to get feedback on that. We also, Joe, if you could pin the Zarco interview, we also had the opportunity to publish an interview with I don't want to call them a startup. They're technically pre-revenue, although they've signed their first joint venture in June. Recyclico Battery Materials Chief Executive Zarco Miselcia. We had the opportunity to interview him. It was a very technical deep dive. So for anyone who's kind of new to that industry, there might be some detail that's a little bit beyond just your overview level. But I think that's our goal is anyone can provide an overview. And I think areas in which we have either ourselves or members of our kind of crowdsourced research community where we can really look to deliver deep insight and expertise below the surface level, that's what we're going to look to do. I think that's differentiated. I think it's a great way to add value and hopefully, provide something that makes people more apt to interface with our kind of knowledge community, if you will. So that's all coming. We have the book club next Tuesday night too. So Mastering the Market Cycle, Mr. Howard Marks. We'll be having that discussion at 8 p.m. on Tuesday night. So a lot of stuff coming in the next several days. Look forward to it. Let me see here. So in terms of the prepared content for this afternoon, I have the thread that Joe posted earlier today pinned. We'll talk through a couple of these and then we'll kind of open it up for discussion about whatever people want to talk about. I see a couple regulars in the audience. I look forward to hearing what you guys have to say. Feel free to come up and chime in on the topics in question. I'm going to start off with a little bit of a Tesla discussion. I'm sure most people have probably already exhausted their Tesla discussions for the week, but we got Tesla earnings Wednesday night, and the results were all right. I don't know. Was it technically a beat on what the expectations were? Sure. Yeah, we have margins deteriorating. We have them doing questionable things where they remove vehicles from their inventory before the quarter closes and then put them back on. They've been doing this for a few quarters now. I mean, they are masters at massaging the story, and Elon Musk is certainly a fantastic promoter. However, the market didn't like what he had to say about the prospects of them needing to cut price further. You had a stock that had run up several $100 billion and 100% year to date. So it gave back almost 10% yesterday. It did today close only down 1%. So, we're still talking about an $815 billion market cap. And it remains to be seen how resilient their margins will be over the balance of the year as just ongoing incremental alternatives to Tesla cars, to Tesla EVs come into the market from various OEMs, as well as kind of the headwind of high rates on automotive consumers' willingness to bear some of these four-figure monthly payments. So they've got the Cybertruck that they discussed, I guess, launching at some point in the next 6 or so months. We got an allusion to an OEM being interested in their technology on the full self-driving, although in Bloomberg Hyperdrive newsletter out this morning, which was a good reminder for those of us who forgot that Elon's done this before. In January 2021, Tesla already said they'd had discussions about offering autopilot to other OEMs. So it's just the continuation of the hype cycle. We're now hyping FSD again as something they expect to happen soon. They are, of course, investing a lot of capital into what they're now touting as their Dojo supercomputer. Part of that discussion was along the lines of the challenges of securing supply. I know Monitive's here, and kind of this has been something that he's discussed and we've kind of talked about for a while, that NVIDIA has no lack of demand for its products. They are going to sell every chip that they can have TSMC produce for them, and people are going to be willing to pay a lot for them. But in the case of Tesla, they alluded to the constraints that places on them. What else is there with Tesla? They didn't, I guess, talk a ton about, but we know the North American charging standard had been getting a lot of traction. I'd seen several kind of analyst reports talking about how much that might contribute to company earnings. But we're talking about, by the end of the decade, something that's going to contribute, from even the most optimistic estimates, less than $1 of earnings. This company trades near $300 today. So, we're talking about, cents worth of earnings many years out. It's just not something that should drive value. But as we all know, narratives are very important and may overwhelm fundamentals in the short run, which has seemed to be the case. So definitely will be interesting to see, if we continue to get these rabid retail inflows into Tesla continuing over the balance of the year that have happened year to date, in when the story is maybe showing some cracks. So I'll pause there if anyone wants to talk or share kind of their thoughts on Tesla. Otherwise, we can keep it going. I know everyone has an opinion, and it can definitely sidetrack us. Not seeing any hands up. I'm going to keep going.
It's crazy. It's still up almost 100% or more this year. Look at the setup.
One thing I heard discussed yesterday, and I will concede I didn't dig deep into it, but was discussion around how significantly long-dated volatility compressed after earnings, which, what am I saying? I'm saying that the people who were long Tesla leap calls really took it on the chin, because not only did you get the 10% move in the underlying down, but you had a very severe volatility compression. So you're talking 20, 25, 30% wiped away from the value of those leap calls. And I think part of that is perhaps Elon's warning that they're not going to go to the moon, I guess, in short order. He's in the past said the stock's overvalued, and it hasn't necessarily stopped it from going up. But that was one other thing I saw called out yesterday, was the significant volatility crush, which, of course, in the short dated stuff, there's always a volatility crush post earnings. But I'm specifically referring to kind of long dated calls, really seeing that. So, Manu, I know you came up. Would you like to chime in?
Well, saying anything on Tesla is always fraught with risk here on Twitter, most of this year. But I the the Tesla charger business, I still need somebody to explain to me the business. There is a everybody talks about the revenue, but there is a cost on the side. They have to pay for the electricity, or they have to
Yep.
have the capital cost of their own. Mega packs, which is still the same. It's you still have to, depending on when the chargers are used, the electricity prices are going to be, all over the place for kind of supply that they'll draw with these superchargers. So it's a risky business. I don't know. I don't see it all, blue skies for that business. So until we see some real data on how much is the actual margin on that business, I'm not sure. I mean,
Yeah. So I saw the Baird report come out like a week and a half ago, and the Baird analyst put out, a couple scenarios. He has an assumption on current supercharger utilization and what the um, impact on both revenue and on net income would be. So using current utilization, which they estimate at just under 9%, we're talking about an incremental 5 billion in annual revenue in 2030, which would be 15 cents of net income in 2030. Now, should utilization rise, which he lays out a few scenarios, it would make sense that if there are more EVs on the road, there are more prospective users of the superchargers, that, okay, you could assume utilization may rise. And he throws out a few scenarios. And even in the highest end scenario, it's talking about just under 16 billion in annual revenue in 2030, but that's only 45 cents in earnings in 2030. So again, that's just not a lot in the context of, you're already trading at almost $300 per share.
yeah, I'd rather trade the peaker that supplies to Tesla supercharger than the the supercharger revenue itself.
Yeah, like you said, that people have very strong feelings about it. I think one thing that's really difficult to understate is there are a lot of people who made life-changing profits off Tesla, and I have nothing bad to say about them for doing so. But what I've definitely come to appreciate a lot more over the last few years, kind of watching how people act around stocks that they get involved with, especially retail investors, is people like to get married to things. And when there's been a very emotionally riveting kind of ride along the way with these stocks, people succumb to a lot of these sunk cost fallacies. And it's not just Tesla; it's a lot of these meme stocks. Bed Bath and Beyond last night put out a bankruptcy plan where the shares will be canceled. It's pretty cut and dry. And yet the stock dropped today in the morning, and very quickly these people are buying it back up.
Yeah, I mean, and on the other side, right, the narrative is equally clear on how much people have lost shorting Tesla. That's even worse of an idea. So, it is not. I mean, it's universally a horrible idea across time, except for fleeting periods of a few weeks at a time. It's been one of the worst business plans to be short Tesla in the last 6 7 years, 5 6 years at least. So it's There are periods when you buy it, and then the rest of the time you stay away. There isn't much of unless it's a very unique opportunity, a very unique set of time periods. It's not a short. It might be a play intraday on the short side, but or even a few days. But
I
longer short
I hear
periods
you.
like that.
I kind of think it's a pretty compelling short right now. I am personally short, but I 100% recognize that anyone who's just held short without tactically adjusting their positions or otherwise adding some convex hedges has had a very bad time over the last several years. Um, but you know what? To me, it's just you're going into a decelerating impulse to spend on these big ticket consumer items. You've got deteriorating margins. A lot of the story is falling to the wayside, and of course, the narrative can continue. I'm just inclined to think that gravity mode might get re-engaged, but you know what? I could be wrong, and the most important thing is to size appropriately and risk manage in the context of a broader portfolio. Because you know, if you were taking a huge short on Tesla, you probably blew up, many
Yeah,
times
but
already.
no, Rod, don't get me wrong. I don't disagree at all that the valuation is not logical in any sense. But this is a $40 billion eco chamber he spent the money on. So it's a dangerous game to play with such a large megaphone that's now been fully it's being you can see this, right? You go to any space, you start talking, questioning Tesla, some of these regular people pop up to push back. It I don't know what else to say it other than it's almost a concerted effort to manage the image of the company and the brand.
Yeah. Well, let's keep moving because we could talk all day about this one, and I'm sure when we get done with the prepared stuff, we will perhaps come back to it. But I wanted to we talk. I know we talked about it last Friday, but I guess it was fitting. We front ran what the major media outlets were going to discuss because there were several stories in the Journal and Bloomberg talking about striking activity and kind of how we're in a very elevated level of that, and that for a lot, we talked about it. He's not listening right now, but I know Sick Juan was kind of sharing what he was thinking and seeing and hearing from the Screen Actors and Guild and kind of on that side of things. But we've got a UPS strike that could be happening come the end of the month. We've got Yellow, which it looks like will be pursuing a Chapter 7 liquidation. So that's going to throw a lot of havoc into transportation markets. If UPS, if the Teamsters go on strike at UPS as well, it's just going to be a very extraordinary. Uh, it's just going to be a really crazy period. I mean, we're talking about hundreds of thousands of UPS workers going on strike. Uh, come the end of this month if they can't reach a deal. Yellow. I think there was a hearing going on this afternoon where the Teamsters would be going on strike as soon as Monday, I believe it is, which at this point, a lot of carriers and shippers have already pulled capacity and pulled, or not carriers, excuse me, shippers have already pulled kind of their loads from Yellow's network. They're looking to plug it into the other carriers, the LTLs, and yeah, it's just like we were talking about last week. It seems like for labor, this is the moment for many of them. They feel like, with AI now upon us, they feel like it's now or never to negotiate protections. And we're seeing elevated levels of organization activity at ranging from Starbucks to even trying to unionize, which they've been trying to for years at places like Walmart and Amazon. So there's been the long-standing decline of unionization in the United States, and it definitely is the most hot kind of labor summer that we've had in a long, long, long time here. And I'd love if anyone has thoughts on kind of the labor side and situation, to hear those.
Right, I just want to throw in right now breaking news. Yeah, AMC is up 80% after hours as the ape deal was rejected. And a surprise court win for the meme stock base zero hedge tweeting out.
Wow. Yeah, I see it. Wow. Okay. AMC closed at 440, and the latest tick I see is at $8. So yeah, a very large move in AMC. It's been a very quirky situation there where the company needs to be able to sell equity. They've been unable to sell common stock, and now it sounds like this deal being rejected is going to force some kind of short squeezing, which it looks like is already happening. Wild. Markets never cease to disappoint. Do you have a link, Joe, that you can? Is there a story out yet?
I'm not seeing one just yet. Oh, look. GameStop's also up like 5% too.
So we've talked about AMC. I won't rehash everything, but we've certainly talked about it several times. What's been going on in this venue? So, geez, this market never ceases to disappoint. So they blocked the conversion, right? Okay, that's it. Yeah, because what was going to happen is that the preferred equity units, the APE tokens, which they'd utilized as a means to get around the cap on common stock issuance. The company had been trying to kind of roll them back into just consolidate back down into the one common stock AMC and allow them to sell more common stock. So now that that's been rejected, it basically sounds like the legal case is just gonna continue. The borrow rate on AMC has been in the several 100% annualized. So my thinking is that anyone who's short AMC now, especially going into the long weekend, is in after hours seeing this news and thinking, you know what, let me just get on the sidelines again or not have to worry about this. But wow. I made a comment in another space this afternoon that this industry, though, aside from all of the noise around the conversion and the positioning and yada yada, I mean, we're still talking about an industry that has not gotten back to pre-COVID ticketing levels and may never. I mean, this may be permanently impaired, and yet, right? When you look at AMC, what the implied value of all the equity is, the enterprise value is still, well, after this move, I guess that's cooled off, Joe. Now it's at 550. So it spiked to $8. It's all the way down to 537 now, and dropping. But we're talking about a north of $10 billion business that, even if you go back to kind of its peak, in the mid 2010s when it did make money, was never worth nearly this much. So it's just another bizarre story of trading token, I guess, being more important than anything fundamental in this market. But okay, anyway, going back to labor, I'm very interested in seeing, because you've got the Teamsters really going to get their pensions wiped out to some extent with this Chapter 7 liquidation, losing their jobs at Yellow. I'm curious if the union heads are going to be satisfied with this unfortunate outcome, and how, or if that plays into the thinking around the UPS negotiating table and or strike. So I mean, we've definitely got a lot of potential bumpiness in freight markets, and Craig Fuller at FreightWaves had made the comment the other night. All that they need next is to throw a hurricane into the mix. Throw a big nasty hurricane in amidst all of this labor and fleet kind of issues, and you're just going to have if you're on Team Chaos, that's all you could ask for.
Hey, on yellow, there was an article I read. I'm trying to find it, and I'll share it with you if I see it. But it the sum of what it said was basically, other truckers are not rushing to sign up customers who are desperate now with yellow going down, because yellow's rates were pretty low and they don't want to sign
Yes.
up at that.
Yes. So that's 100% right. The market rate for LTL hauling is far above what the contracted rates were for shippers and yellow. In yellow, I mean, we're not talking about a small amount of capacity. We're talking about 9 or 10% of all of the less than truckload capacity in the entire industry. So it's a meaningful takeout of capacity, and you're right. The other carriers, which I know we mentioned last week and have mentioned other times, your Old Dominions, your XPOs, your Sayas, they've run up meaningfully. Old Dominion is up 25-ish% over the last month or so. Saya is up 28% over the last month. So they've already front ran the assumed economic benefits from the yellow failure, as I see it. And then the question is, okay, now what, right? Will they realize structurally higher earnings as a byproduct of this failure? Of a highly unionized carrier who had a lot of rates locked in at below market levels. It's definitely, to the point you made, it's a challenge for shippers. If your budget was X and now yellow has failed, and now you're going to need to ship at X plus 40% higher to continue getting served. It could impact some players for sure. Okay, so D-Bone, I know you. I'll bring you up. Derek. Uh, I'll bring you up if you'd like to chime in. You'd requested first, so you're welcome to
Hey,
chime in.
I'll add a couple of things on just what I see happening here, and we can table them for talk later. So massive dark pool prints all day today, especially on mega caps. You're talking about tens of millions of shares. Today, pretty large. Running into billions of dollars for each of these companies. 15 million in Google, roughly 10 orders. I see about 30 million in 3 orders in Intel. I see 15, 20 million in Qualcomm and about half a dozen orders. These are massive, right? It does happen, but it's not common on a day, and it's this is more probably related to the rebalance and the adjustment of weightage. But that's one thing I wanted to highlight. But also going back to your the weakness of labor and the AI story, there's 3 or 4 companies here that are actually pushing hard on the remote staff to to reverse their decision and come back to work 3 days a week, and they're tightening down on who's approved for remote. And Amazon story leaked that they've sent their remote employees to relocate to be closer to their primary location so they can come into work 3 days a week. So there's a lot of effects to this, and it's playing out.
My girlfriend works at a GSIB, and they also are leaning harder and harder on getting people back in 3 days a week. Um, Derek, like to hear you chime in.
Yeah, I'm just wondering if this run up in after hours is because they're forced to buy the stock since it's been on the threshold list for FTDs. Just asking a question. That's all. I'll go back to listener.
I mean, just seeing that the spike is occurring on the back of the news, which just kind of recap. I have the yeah, if you're in the Wook Capital Discord, I'm screen sharing. So Bloomberg came out with the story on the judge rejecting the deal, which sends him back to the drawing board. But you had an extraordinarily high borrow on AMC common stock. So if this is now going to mean a delay in a resolution, then if you're short the common, you may decide, you know what, let me take the loss, let me close out and no longer incur that extraordinary borrow because I now have this uncertainty around when the situation will be resolved. So I would say it's likely less to do with any failures to deliver and more to do with, you know, risk management, seeing this news coming in after hours. Chris, I know you follow this stuff and kind of follow the murmurings of folks. So I don't know if you're coming up and you wanted to chime in on the AMC stuff or.
Yeah, I think another thing, I don't know if you covered it, but the cost to borrow is 1,000%. So, and we have a weekend coming up. So you kind of don't want to be paying a borrow on double the stock price.
I mean, it's extraordinary. The iBorrow desk, which pulls from Interactive Brokers pool, shows, as you said, a 992% annualized borrow, which is just incredible. I know there's a member of the GMEDD Discord who is long AMC common and has been lending his shares and has been showing us receipts of, you know, thousands of dollars of lending income. So yeah, it is a very peculiar situation. I think you're spot on that people are, you know, like I was also kind of saying, trying to get out of the way, not paying the borrow now that this, because the reason the borrow had gotten so high, right, was a lot of people piled into the trade, shorting the common, thinking that this would get approved. This is a surprise.
Yeah.
I mean, this was not the expected outcome. So now the market is rapidly, you know, kind of repricing, you know, what it should be. But again,
we have an update.
You know, from a fundamental basis, the equity is worthless in my view. But you know, that
I think the member of our Discord exited at $8.50. So he's out.
Oh, he exited in after hours
at 8.50, which is the literal top.
Wow, this thing is just all over the place. I mean, it went to 8.50, it went down to 5 and change. Now it's back to $8. Man, we are nowhere near the end of this mania, are we?
It's back to 7 now. It's quickly going back down.
Davis, I know you came up. Did you want to chime in on that or something else?
Oh, you were talking about the freight. I just shared it's up here in the nest, something that says 50,000 trucking companies have ceased operations since May 2022. I was just some info about the trucking industry.
Yep. So to step back, you know, I worked at Ryder until the end of 2021, and I worked very closely with our used vehicle team. Gino, the head of UVS, and I got to know each other pretty well. And Gino would always report back to the C-suite and, you know, keep me in the loop that you had massive amounts of new entrants into the industry buying used equipment in 2020 and 2021. And the data show that when you look at how many new fleet authorizations there were, new entrants just buying up equipment, right? Freight market was hottest it's ever been in that period of time because of the goods kind of surge that we had. So you got a massive inflow of new participants, and now we're just still going through spitting them out, and it's not done yet. There's still a lot of folks who came in that haven't yet gotten, you know, the revocation that you were just alluding to, but that is the way the industry works. You know, you get big expansions in capacity, then clearly there's a mismatch with oversupply relative to demand, and that's where we still are. Demand is still relatively light, capacity is still too high, so you are continuing to see a rationalization of supply in kind of the surface transport market.
Yeah, I think some people we used to go to church with, they had I think it was like 150 fleet trucking company, and we were coming back from Florida, and you could see their trucking company from the highway in Mississippi, and I think my wife or somebody mentioned something about there not being any trucks on around the warehouse. So maybe they've ran into a little trouble themselves.
So this is another thing that's I've mentioned in other venues, but just to kind of reiterate, you had the manufacturing plants shut down for a period of time, right? So you had a big drop off in supplied equipment, new equipment. You had what I just mentioned, where there was a huge uptick in demand for equipment. So prices of equipment went to the moon. Those prices are still very elevated, but when you look and see kind of retail sales figures for new class 6 box trucks and class 8 day cabs and straight trucks and sleepers, like there's still an elevated backlog. It's like 1.5 times normal on the class 8 side. It's more like twice normal on the medium duty side, because if you're a trucking OEM, you prioritize the class 8 stuff, the higher margin stuff, the stuff you're going to generate more gross profit on at the expense of the smaller, slightly smaller trucks. So now you're still working through these very elevated backlogs, and you have a trucking fleet that's still aged somewhat. PACCAR has kind of called it out for a few quarters that the fleet is still 10-15% older than it should be. So even though you're in a freight recession, the equipment side is still very hot. And if you're an OEM, or if you're a supplier, if you're an Allison Transmission or PACCAR or Cummins, you're still seeing quite good demand because of, again, all these kind of weird things that happened as a byproduct of the pandemic that threw a snag in the normal flow of equipment. So it's getting back toward normal, but prices are still elevated. And I made this point: if Yellows does in fact move to liquidate, that's going to be a massive deluge of day cab tractor supply. That we're talking about, double the biggest failure in transport history. We're talking about like 11 or 12,000 tractors that are going to just flood into the marketplace. So you may get back into balance sooner rather than later as a byproduct of that. And it's also going to potentially, impact if you're like a Rush and you're a truck dealership. How's that going to impact you for a rider, right? You're selling used, day cab tractors, and now all of a sudden there's this deluge of supply that leads to prices going down. So there's definitely going to be impacts across the space. And it'll help, I think, lead back toward more normalized levels faster if you purge that much equipment supply and throw it into the used market.
Yeah, it's my understanding that the trucking industry is a very small profit margin industry.
That's right.
So I'm sure, if you're rule number one, if you're going to start a business, better to be in a business with larger profit margins. So I'm sure if anything changes too much, it really does put a squeeze on people that have these little trucking companies.
And most of it is very small fleets. On a percent of total basis, it's like 80-90% of the fleets are one truck, 2 truck, 3 truck kind of mom and pop operations. So,
but bro, listen to this. Imagine if you had 100 trucks and there was some kind of software that finally came out where these trucks could drive themselves, and you could keep all your contracts with whoever you're moving freight for. Bro, you're talking about how big would your margins be then if you didn't have to pay somebody,
well, I'll
$75,000 a year to drive?
Pull up this graphic. When I was at Ryder, we worked with McKinsey extensively on disruptive technology sizings, and they had, in 5 years ago, talked about how much total cost of ownership takeout you're talking about. So directionally, we're talking about if you went to full on driverless. And Joe, maybe I don't know if you can kind of Google this and reply and pin it so anyone who's not following can see. But there's kind of from ranges of autonomy on over-the-road transport. You've got like just a platoon where you still have both drivers in the truck, but the trailing truck is electronically connected to the leading truck, and because it's drafting, it's able to save a mid-single-digit percent fuel economy. That sort of thing might lead to like a 1% TCO was McKinsey's math. If you have a platoon where now you only need one driver in the leading truck and you can digitally kind of sync up the trailing truck without a driver, that would be an incremental 10% TCO savings. And then there's these more automated solutions where maybe it's a port to port, maybe from a location off of I-10 in Southern California or in Arizona,
or you just don't have to
send
pay
the automated truck without a driver over the highway, but then a driver gets in to finish the last few miles to bring it to the dock. That all of these have different degrees of cost takeout, but the biggest thing to remember is that labor is the biggest cost item. I worked in dedicated truckload pricing at Ryder, so I've built many a pricing model on it. And yes, if you take a driver out of the solution altogether, it massively changes the economics. But what people have been talking about that being around the corner for a long time now, just like Elon has with FSD, and it's not.
What if you didn't take the driver out? You just gave him like a 40% pay cut because they weren't having to drive. So it's not that hard of a job. I mean, let me say this: being a truck driver is a hard job. It's really not an easy job.
But
imagine you pay them 40% less because they all they do is just sit there and watch Netflix, and then an older person could do the job.
That's not how it's worked operationally for they're actually paying those drivers more. The safety drivers in these early deployments are typically very well seasoned drivers that they pay above kind of your entry level market rate. So the inverse is true. At least that's been the case in my experience, talking to many of these autonomous trucking companies.
Well, McKinsey, first of all, doesn't know what they're doing. They mess everything up that they touch. But that's just my opinion. But one thing I think that the autonomous driver could do is lower the liability costs and the coverage for a trucking company, right? I don't know. Interested to hear what you think about that and what the takeout costs would be for insurance, right?
It's just as possible as Elon's humanoid robots driving the trucks. I mean, it's not something that I ever heard come up in discussions. I mean, one thing that is a true statement is that
here's my
realize
question,
fuel economy savings.
As Ryder, you get dinged by Morgan & Morgan for $5 million because of a fender bender where somebody broke their ankle.
Yeah, so I'm just going to put it like this: if you're in a courtroom and it's going up against a robot truck as for a nuclear verdict or with a driver,
for a while.
The jury is probably going to be inclined to side with the trucking fleet's robot.
No, I totally. Hey, I am not an autonomous driver proponent. Like I play devil's advocate with myself, so I actually hate the future.
But I mean, look, I do absolutely think more so than automotive that over-the-road trucking is better suited for getting these sorts of autonomous driving solutions. But you've got to remember there's a lot of these are all going to start out like what kind of Too Simple had laid out, and a lot of the whether you're talking about Daimler or Volvo or whatever, they're all kind of looking at starting in, say, a Texas, or starting in like the I-10 corridor in the Southwest, where you don't have a lot of, you don't get snow, or it's sparingly, you don't get a lot of inclement weather. You need to have the right conditions. And that's where, when you think about level 4 autonomy is just conditional autonomy, right? And the level 5 that people talk about is where there's just full-on unconstrained autonomy. I mean, that may never happen. Like a full-on level 5 where it could go anywhere in the entire world with no constraint. I don't believe that's likely to happen. But you already do have, right? You have on the automotive side some level 4 operations from Waymo and Cruise. but there is in fact a bigger economic case to be made for over-the-road trucking if you could, get some automated route density in like the I-10 corridor. And a lot of companies try to do that, but they've all failed so far because so far it's.
What's the margin impact of that? Is it worth it? And does it actually ever
If you
meet
truly
any?
took the driver out and you didn't have a safety driver, I mean, you'd be lowering your total cost by like 40, 50%.
Bigger than I thought. Yeah.
It would be a massive revolutionary change.
Do you think that we ever reach critical mass in that regard, though? It seems like everything has to happen all at once, but it can't start slowly. But it has to start slowly. I don't know.
Yeah, Monad, if you want to chime in.
Yeah, question on that. When you talk about the saving of taking out the driver, does that include the cost of whatever the subscription is to to enable self-driving and maintain all that? The additional capex for it and
Well, he listened to
Right, we don't know
McKinsey.
what that cost is going to be, so
McKinsey's
that's
ruined
a
every
great point.
company. McKinsey doesn't know what they're doing, so let's just be honest with each other.
I mean, I'll just say when I spoke with McKinsey experts during my time at Ryder, I was pretty impressed with their knowledge, but I understand a lot of people don't like consultants.
Well, they make shit up, and they try to make this world up when in reality it never gets applied practically, and it costs everybody a ton of money. So, like, they're just trying to sell people shit. That's it.
Yeah, I mean, a lot of them had extraordinarily deep industry expertise, in my experience, but you're right, no one knows the future.
What about Too Simple? You remember that autonomous trucking company?
I do. I worked closely with them during my time at Ryder. They're gone. They've failed. So has
they're
Embark.
out?
They're gone. They've failed. The people that likely I think end up winning this are the boring ones. I think Daimler Truck, who bought Torque Robotics several years ago. Your incumbent players are more likely to be the ones who win this because this isn't. It's a thin margin industry that can't bear the risk of going out on a limb on these startup fly-by-night organizations. So Daimler Truck's been building their Freightliners for decades, and now they're going to bring out a Freightliner that has the equipment off of the production line that is necessary to enable automated driving. Right? They're going to be more apt to go with a DTNA versus insert startup here. I mentioned this in a call the other night that was kind of a big takeaway from on the electric side, not on the autonomous side, but on the electric side. When I was part of our kind of electric vehicle team, the CPO led the initiative. We met with all of the startup and incumbent OEMs over the course of 2021, kind of talking about what their electric truck build plans were for the coming 3 to 5 years, pricing, what are the specs, yada yada, and in a nutshell, the takeaway was we're not going to be partnering with these new players. It's going to be adopted from your incumbent players broadly on the commercial side, at least. That was kind of our takeaway.
Yeah, I wasn't trying to object with the whole McKinsey comment. I have a soft spot for them, so I'm sorry about that.
It's all right. I mean, look, we could all take cheap shots at the consultants, and
Right.
they deserve a cheap shot every now and again. But
They ruined my industry.
There are
though,
certainly
man.
look. There's the fresh out of school consultants. There's also the the guys who worked in industry for many years and now kind of are their SMEs, and I think a lot of those guys and gals are pretty darn sharp.
No, they're sharp. They come in and they control my my head of whatever, and it's just like, dude, why are we buying into this crap? Like, for me personally, and I'm not
look,
saying
I'll echo that though. When I was on the strategy team, right, the kind of what McKinsey or BCG or whoever, insert name here, would have to say, it's like we could have produced the same type of work and brought it to the board, and We didn't have that brand name rubber stamp on it though. So if we were wrong, it's a lot
Isn't it
easier when it's the consultant that's wrong.
isn't it usually though that they brought them in to say something that they wanted to say anyway and get the board to adopt? I think that's usually what happens, but for us it was kind of the opposite. It was just like we had a board who was probably a little upset with the trajectory of stuff, and they brought them in, and then they looked at everything and they fucked it up really bad. So as a lowly person, I am deeply impacted by Mackenzie's lack of understanding of my industry. So uh, that's it.
Got it. So just for folks who are listening, we're kind of talking a little. We were talking about labor and kind of what's going on. We kind of toggled over to autonomous trucking and labor impacts. To go back to what you said, Monitor, though, which is definitely the many billion-dollar question. So, all right, you take cost out by eliminating labor, by reducing fuel consumption because the vehicles are automated and can drive more efficiently. But then how much does your cost rise to pay the subscription to the autonomous fleet provider? That is the unanswered question, and we don't have the answer to that. No one has an in operation commercial service like this. They all have safety drivers still. I've made the point, and I actually saw Ryder participated in a venture investment in a it's for like for kind of integrating AI and autonomy into the yard, where you have yard tractors moving trailers around on a site. That is an off-highway thing. The regulation is a little different when you're not on public roads. So that's another area. Port and yard kind of automation and autonomy. China has its automated ports, but that's something you're going to probably see more penetration of the autonomous application sooner than you'll see mass fleets of over the road robo trucks.
Is it Honey I Shrunk the Kids type stuff where like they just tie a string to the mower and it goes around the circle? Just kidding. I mean, that was a good movie if you saw it.
All right, let's see. The last, I'm not going to go through all the remaining stuff. I'm going to dovetail the last item from the newsletter that kind of does tie into some of this freight discussion was talking on the air cargo side. So typically high value, think computer related, higher value stuff that's going to go stale quickly if you can't immediately bring it to market would be what you would put on an air freighter over choosing a slower shipping method. So there's been kind of this ongoing weakness in demand for air freight. There's from kind of the discussion of a lot of executives, not an expectation of a big recovery during the pre-holiday shipping rush in the back half. Freight forwarders and cargo airlines have been trying to chase volume without considering costs, so rates have been declining further. So I think this is just similar to the kind of highway freight discussion. You kind of have air cargo showing no demand, like impulse yet, and rates dropping. And then the last item I was going to point out, which I'm sure people have seen, a lot of these sentiment indicators are back at extraordinarily high levels, whether it's the AAII individual investor survey, the NAIIM. A lot of these are back toward late 2021 levels of bullishness. So of course that doesn't mean stocks are going to go down. It just means that we've quite rapidly swung to a pretty ebullient and perhaps euphoric landscape with a lot of bullishness out there. So how short investors' memories are about last year, that we are back max long again. But that's all I had in my prepared content. So now we can kind of go wherever people want to go, all over the place, and want to talk more about AMC or trucking or automation or whatever. I know we talked a bit about electrified kind of trucking in a couple spaces earlier this week too. So I don't want to repeat anything, but yeah, whatever people want to talk about. It's 5 o'clock. I'm happy to keep this open till 6. And yeah, so anyone who wants to come up and speak, please feel free. We'll talk about whatever people want to talk about.
Is somebody talking?
Nope.
So I was talking about this earlier. I don't think you were in the space, but there's this company. It's called Cerence. The ticker symbol is CRNC, and I think they're trying to make like an autonomous assistant or an artificial intelligence assistant for cars. Apparently, they partnered up with like Mercedes, and they're providing this AI that's just going to be like your personal assistant in the car. And it's supposed to be seamless. You're not going to have to touch buttons or like say its name. It's kind of like the AI is kind of intuitive, I think is the deal here. And I think Mercedes is just now offering this product in their higher end cars. Have you heard of this company?
I haven't.
So, I mean, it's only $1 billion market cap, and they're doing something with XM radio where they're, I think, maybe going to try to offer a service through XM radio where your XM radio would have like an AI. They're going to offer packages where they're like the highest end package will have like an AI assistant that comes along with the XM radio, I think is what they're trying to do. But I mean, how does that sound to you? I mean, sounds like it could be a growth play, maybe.
I'm just looking this up, right? I don't know this either. I'm just looking it up on bar chart. They lost $310 million on $330 million in sales. This thing is far from anything. I don't even know how to explain this.
Well, they got a product in their Mercedes Benz, so I mean I guess that's a plus, right?
No, of course. I'm not. I mean, look, it's surprising that they have 330 million in sales, but they're losing their shirt on it. So, well, they're losing almost all of it. So, I look. This might be, either the inflection is coming quickly enough, or this could be, this could be I have to look and see how long of a runway they have to survive because this is expensive way to run a business.
Did you by chance see XM Radio Monative today?
No, I haven't heard of. Well, okay, I know what XM Radio is. I don't follow them. It's not interesting enough for me. But Cerence, I heard you on the other space talking about this, but I've never looked at Cerence. I've never heard of them. But this is curious. I mean, look, 327 million sales or 330 million sales is not anything to sneeze at. So they have some revenue. Question is, what are they doing with it, right? I'll take a look and get back to you, man, what I think.
Yeah, that'd be amazing because when it comes to like looking at the financials and stuff, I can look at it and kind of get a feel, but nothing like what you guys could probably do. But yeah, I figure somebody would think it was kind of interesting. And like I said with this video, and I probably have a misunderstanding, but they want to offer like a premium XM radio package. I don't know how they're going to offer AI in a car. I don't know how that's going to work out, but there's something there too. And they were supposed to have this product finished by now. And there was articles out 2 years ago about this. So I think maybe some of the price action that you've seen in XM radio is people that are more knowledgeable of this matter know that there's there's some kind of press release around the corner, could be front running it. So I don't know, probably, and it could be something totally different.
Another angle to consider is that more than a third of the float of that stock was short, so it looks more like a short squeeze to me than any sort of meaningful fundamental change in their business. But I'm not an expert on it.
Yeah, probably. You're saying
But
for serious.
this has been the summer squeeze season. I mean, we see AMC after hours. A lot of these stocks that were perhaps justifiably left for dead or to dead at the start of the year have done. They're now up like Carvana, 1,000+%, and they have probably put some shorts in the ground. But what does that tell you about go forward business prospects? There's a lot of hope embedded in a lot of asset prices, I guess, is what I would say. Giro, though, you came up, and I know it's late for you. How are you?
Hello, I'm very good, Rod. How are you doing?
Doing pretty well. Very, very, very
Perfect.
excited to finally get our report out soon.
Perfect. I'm also looking forward to your report. Yeah, maybe from my side, I mean, I know I told you already, but for the group, Goldman adjusted their recession probability downwards to 20%, which is interesting because the long-term average is 15%. So basically, Goldman is saying it is average, how do you say? It's like average recession probability, meaning we are in normal times, yeah? But they are arguing also well. I mean, number one, I also want to say that the chief economist, his name is Jan Hatzius, and he's not a how do you say? He's not a perma bull like a couple of FinTwit accounts here, who are always bullish. It doesn't matter what. But he was during the financial crisis. He was very critical, and actually he actually already warned, I think, in 2006 of the financial crisis. So he's not he's data driven, yeah. So let me maybe highlight for the group how he's arguing, right? So the 20% probability, of course, it's a little bit subjective, but he's also arguing basically that GDP is still trending above 2%. Unemployment still at 3.6%. Whereas the Bloomberg nowcasting model is actually currently predicting that unemployment rate would go even down for July. But of course, we still need to wait for a couple of data points, to confirm this trend. And he's also saying that the student loan payment will be a drag on growth, but it will not be big enough. So basically, he's saying that inflation will come down, and it will come down to an acceptable level, which will not require a recession. And these are his words. So also an important thing to highlight is, and I will later also write a thread about that. I mean, it's interesting to see that the consensus of all the other banks basically, is around 60% recession probability right now, and like I said before, and for Bloomberg it's 20%. And if we look at the whole hiking cycle, Bloomberg was always below the consensus.
It's certainly over the last several weeks, months, this rotation that's now been going on. I mean, over the last 30 days, energy is the first sector and second is financials. If there were a recession around the corner, you wouldn't expect to see those as the leading sectors. So I do kind of in line with what you're saying, think markets are perhaps shifting their positioning in that direction of less likely. It seems to me, and I know you mentioned this in one of our group chats, that the base case is soft landing and that is becoming fully priced.
Yeah, and also, I mean, now because I will also share this later. The S&P 500 earnings, and I think Monetiv is also very close to that. So currently we have 87 companies reporting. So let's say almost a fifth. Yeah, and I'm talking not about earnings beats, but I'm talking about absolute growth. Yeah, so sales growth plus 9.4%, earnings growth plus 5%. Way above all the estimates, right? So although of course there are certain sectors which haven't reported a lot yet, for instance communications or healthcare, but if we look for instance in financials, it's more than half have reported already. Great numbers. Technology, 1/8 of the company have reported, and in consumer discretionary also a fifth have already reported. And yes, so and especially consumer discretionary is also very cyclical, right? And yeah, I don't want to be too optimistic, but at least to all these people, and there are a couple of FinTwit experts who say we are already in recession, or we have been already in recession. And when the NBER will how do you say it? When they will date the recession, then they will date it back to March this year. I mean, I'm very confident that we
People
are
are
currently
saying that?
not in a
Who's
recession.
saying that?
Yeah, I mean, I don't want to name names, Rod. No,
Well,
but there are
I
a
mean, I know
handful
we've
of.
talked
Yeah.
about it, and I know Monetiv has his hand up, so I want him to chime in. But we've discussed that having rolling sectoral and geographical recessions doesn't mean that the entirety of the American economy is in one. And we've had a freight recession going on. That doesn't mean the economy writ large is in one. Manufacturing is in some spaces undergoing one. In other spaces, it's booming thanks to stimulus, right? So I think it's just a very nuanced landscape where there's a lot
we
of
had
different
at
moving
least
parts.
we had at least 2 quarters, maybe even 3 quarters of a tech recession. It was pretty hard, right? Remember those a good million plus, jobs that
I was
were
just about to say how many jobs were
taken off.
layoffs in that sector. Yeah, it was meaningful.
Yeah, but going back to the data, Jero, yeah, this is something I look at on a daily basis. I look at Refinitiv, but same data. But
Yeah.
couple of things you have to remember, right? It's still a little bit early. I think 2 weeks we'll know because of the heavily weighted stocks, right? Like consumer discretionary, for example. Tesla's reported, Amazon has not. Those two probably the bulk of the sector by market weight. So by the time you get Amazon's earnings, you'll know for sure if discretionary is going to beat their earnings estimates, right? That's what I'm saying. So financials are pretty good that they are up about 8% over expectation in their earnings. So that 18% earnings contribution that comes from financials is probably going to do better than normal or better than expected, right? Tech, it's too early because nothing
Yes.
of size is reported. So 18% of S&P earnings comes from tech, 18% from financials, and 15% from healthcare. So I think in about 2 weeks' time we should have a much better account of it. But if you adjust and extrapolate a little bit, you're right. It looks like we'll have another 70+% beating, which is slightly above above long-term averages. So this is going to end up being another good quarter.
I made one more point to you guys, Monetiv and Rod. I shared also before that global PMI, right? When you look at certain leading indicators, I mean, it is a index created from Deutsche Bank, I believe, or S&P Global. I actually don't know. I have to look it up again, but it's basically a mix of Chile exports, Taiwan export. I guess Chile export because of commodities, yeah. Taiwan export because of semiconductors, I believe, and then also Korea semiconductor export. So it's a mix of these three indicators, and these three are actually kind of with a 3 months lead. I actually kind of predicting like where global PMI is heading, and this indicator already bottomed out like 3 months ago. So if the relationship holds, then global PMI is actually already in an upwards or would have bottomed and might be in an upward trend, right? But that's assuming that the relationship still holds. So that's another positive news. Another thing also, because a lot of people are talking about unemployment claims are leading unemployment, right? And everybody's saying, and correctly so, and rightfully so, that unemployment is a super lagging indicator. And if you look at unemployment, you will be way into recession, right? By the time it picks up. So, okay, so unemployment claims is much more important. But also this number is actually way too low, right? So also this little tiny pickup, and it's also picking up slightly, it's picking down slightly, picking up slightly, down slightly. So we are way how do you say? We are very much away from a first sign of trouble in the in the labor market. And if the Bloomberg nowcast is actually correct with this very hot NFP print for end of July, and downwards from 3.6 to 3.5%, right? So actually, unemployment might move in the wrong direction, because the Fed was predicting by end of the year 4.1% unemployment. We were already 3.7, and if we really head down to 3.5 plus NFP of I don't know what was the number that I saw, 360K. Yeah, I think it doesn't look very recessionary at all.
Yeah, and I'll add something, Jero. I mean, look, we are so far, into full employment here, and we've been for a while, that the normal bounds we look at, 50,000 plus or minus, expectation is a worthless measure at this point, unless we see something ticking below 3%, in which case we might have significant wage pressures pick up again, or we see a 500,000-600,000 new claim print, where it's a sign that maybe things are starting to widen out in unemployment rate again. I think it's meaningless. Everything in between, it's sort of like it's a little adjustment, but it's still effectively full employment. It really doesn't matter. So we have to see the extremes to start to see anything useful from that data. I think you can safely ignore unemployment data unless it's out of bounds and a significant large number in any one of the monthly prints. I don't see it.
Yeah, so maybe can I ask the speakers here then, in which sectors are you considering to put more weight or rotate? Because of course, if inflation goes down, then as we I think discussed 2 weeks ago, then consumer discretionary and technology will benefit the most, because they behave a little bit like bonds, right? Because of this long term, how do you say this? Because they're growth stocks, and all the future earnings are in the future, basically, right? Like a bond where the coupon is very far away. Do you also see other sectors which might be very interesting in the current environment, or do you not only look at inflation coming down, but also at growth or a lot of other factors?
Well, personally, I watch tech because I'm right in the middle of it. I think it's very important to see through what Microsoft and Google say next Wednesday. I still am of the opinion that the AI revenue stream is a little further out than people are counting on today and people are pricing in today. And if that is true, then we're going to see a big sell-off in tech. If I'm wrong and we see revenues already showing up, then then tech stocks are cheap. I'm sorry, there's no other way to put it. But that's to me in tech, right? So it's almost a binary event that I expect out of not so much numbers. I doubt we are going to see anything more than a rounding error in the last quarter. but in the guidance. I want to see if they are, gutsy enough to guide next quarter revenue to be impacted positively by AI. I fully expect expenses to have blown out because of spend on AI, but I'll be very surprised if I see revenues this year from AI. I think it's all 2024 or late 24 start. If I'm wrong and if the revenues start coming in, then we're talking another big bull cycle in tech that could that could erase what we saw in 21. But again, this should really again not be the shit coast, but rather companies that are in the mix, right? Your Microsoft, Google, the usual players, Meta to some extent, and Adobe, a few others like that. um, Outside of that, based on I follow defense a lot, and the industrials are so far so good. um, if you believe the numbers from LMT, Lockheed reported last Wednesday or Thursday, Wednesday, and they beat. They raised significantly. Uh, it's a low margin business, and there was really nothing negative in their report except they are keeping a very conservative outlook on the F-35 deliveries. F-35 is just one of their programs. Of course, it's the largest, and it holds sizable part of the backlog. But for just that one reason, the analysts, took down price targets. I think it is very short-sighted, and I don't think anyway. Even if that's the case, uh, the rest of the sector is not equally impacted by that, because the only other player that has a massive presence in this in the US is Raytheon as the engine supplier. So I think you're going to see so defense has not had a positive run this year, right? So they're still a few low single digit percent down for the year. Rest of the industrials have done much better. So there will be catch up trades like that. I think industry specific catch up trades where the results are good, the outlook is good, the industry macro is good, but the companies have not participated. So I think there are stories to be had like that, and that's where you go searching for it. Could be parts of energy industry, parts of chemical industry, parts of materials have run, other parts have not, so maybe there's a catch up there. So I think you have to start looking industry by industry to see where the money is going to move, especially if what I think comes true in tech. It doesn't sink the market, it just sinks the index because index is weighted, but the rest of the sectors and rest of the industries might do just fine.
Yeah, it's a very good point, Monetiv. I shared the tweet from Agnos Stocks, Ole Schrupp, and he's making a little fun of. I mean, rightfully so. Rightfully so, to be honest. Like the private clients, right? In the last couple of months, they invested a lot in money market funds, right? And now it seems like that they are taking the money out of money market funds in order to invest in invest in the tech sector, right? Um, yeah, so it will be interesting to see like how much more is left. I mean, they will not take all of it out, I believe, right? Because to be honest, like 5.5% or 5% is still very attractive. I mean, 5% risk-free compared to you invest in tech now and might be down easily 20 or 30% if something happens, right? I mean, we never know.
But that's just the way it works. Prices go up, people get optimistic. And
e-
all of the survey data show that we are in we've swung extraordinarily from the lows, 7, 8 months ago, and now we're at extreme greed.
exactly.
Insert phrase here. So it's not surprising to me that people see price rise and now they want to chase.
Yeah. I mean, we talked about that about asset manager positioning, right, and all the other institutional clients like that they also want to get some extra return in order to catch up with the benchmark that they lost to basically in the first 7 months of the year. Uh, I'm also wondering like how much European and Japanese money is also left in order to enter the American market because I can also imagine that they thought to divest a little bit because a recession is near, and then there was a big narrative regarding Europe is much more value driven, right? So in case we are close to a recession, value should outperform. Then we also have had then we had the Japan trade, of course, also because of liquidity. So if that reverses, Rod, then I mean maybe there is some more legs to go. You know, like a couple a couple more months of I mean purely
Hey,
from a
equity risk
positioning point of
premiums
view.
can always get
Yeah.
slimmer, Giro, right? They get slimmer until they expand and until spreads expand. But you're right. I mean, broadly speaking, if you're and I've admitted this, right? I had a more negative viewpoint than what's panned out year to date, and it's impossible to refute that the economic data have consistently, especially in recent weeks and months, been surprising to the upside. To ignore that is to have your head in the sand. But then, speaking about the relative level of valuation, right? If you're talking about what is the forward return profile when you're already at what I would consider quite stretched valuations, given what rates still look like, it's many sectors don't look attractive, but as we've discussed, I think there are some that do. So you don't need to put a line in the sand and say that things are all going to hell in a handbasket. Obviously, for people trying to sell newsletters or sell engagement, it's much more engaging to say the extreme things. But I would 100% agree with the sentiment that clearly the real economy has been far more resilient than people expected, and that there aren't signs that there's some impending doom looming. But Steve, I know you came up, and I'd love to hear if you had thoughts on this discussion, or if you wanted to chime in.
Yeah, hey, what's going on? How are you guys? Hey, I got a couple things, but since I saw the AMC news, I was just gonna mention this company that we have been kind of bragging about for the past decade, Bed Bath & Beyond, just to put in closure. So I think they finally the restructuring firm they work with, I think it's called. They finally filed their formal Chapter 11 bankruptcy plan, restructuring plan, and then they filed it, I think, yesterday. Very long document, but I think that the point is that I think a lot of people or maybe some people some equity holders are trying to get some hope out of the recovery. But I mean, if you go through the notes, pretty obvious there's a very slim hope for any equity holder to receive their.
I don't think there's any hope.
Yeah. Well.
I mean, the plan is pretty straightforward. That the BBB class, those shares will be canceled.
Yeah.
I mean, I've heard people continuing with their tinfoil theories around why that's not the case. But yeah, I mentioned it earlier, and you're spot on. The plan came out late last night. It dumped this morning. You would have thought it would head towards zero, but people bid it back up. I will note, I shorted 10,000 shares at 33 cents. I mean, today, the fact that you're able to short a security that the court filing notes it will be canceled, as soon as September, wiped off the face of markets. This equity is, it's a bankrupt security being canceled. The fact that people are still buying it is sad, frankly. The delusion that people are willing to, I guess, live with. But yeah, I shorted more of it today.
Yeah, so I would say any equity holders trying to get a hold of this, I would encourage you to go to Crow's website. They have pretty comprehensive documents and one of the documents is 4028. Not 4028. What's 4028? One of the 4029, I think. It's like 61 pages of detailed restructuring plan, and then you will find out what you need in that document, and if you have doubts on.
Steve just shared that the disclosure statement just dropped on Kroll. This was like half hour ago. They said, quote, all or substantially all of the assets of the debtor's business will be liquidated through the asset sale transaction, and the plan affects a wind down of the debtor's remaining assets. Although a Chapter 7 liquidation would achieve the same goal, the debtors believe that the plan provides a greater recovery to the holders of claims than a Chapter 7. So they're not switching it to Chapter 7, but right, it's done. It's over once this plan is approved. I don't know what remaining theories we'll see between now and then about some phantom M&A that isn't mentioned in the plan, but yeah, a lot of delusion out there, unfortunately, about this one.
Yeah, so hopefully we can finally turn the page of this chapter, close the book for now. But I was going up the equity line here. So the next company I was going to mention, well, there's a couple. They're all in the same industry, right? So there's a sense. So Bad Bath Beyond, one of the, when you talk about Bath and you're thinking about Wayfair. I know you're pretty vocal about Wayfair recent roundup, which I actually, so there is a, so I mean, probably everybody use, so you probably know there's a tracking data people use on the different sites to track the online DAUs and downloads. So it's on sensortower.com. And then so Wayfair is actually leading the pack in terms the growth rate. I think it was like as high as 50% for the June or something.
So you mean they're going to have more customers that they can sell things at money-losing prices to? Because I mean, this is a company that never, even during the peak of this demand boon, that they barely got to positive adjusted EBITDA, if I have it right.
Yeah. So the thing, my point is that I think it's just like what we're seeing in Tesla, or even what's another company that's Netflix, is that you have this positive sentiment that people are anticipating good news, and sell side are pitching the good news based on the latest data. So it's similar, setup here. I'm just saying, like, in terms how people are bidding on this company because the DAUs. So that's interesting. And then just for the next another company I mentioned before. Just to recap this, what happened was TSMC quarter. So I mean, obviously lower outlook, and so it was kind of disappointing. But I think one of the things that you want to look into is really so the narrative AI, right? If AI demand can really offset some of the lower demand in some areas, right? So there's two type of trends, right? There is the PC hardware trend, and then there's the software AI trend. And then obviously, if you're looking at their data, so I think the TSMC sees that AM demand pick up like which is like 6% of their sales, right? But it's not enough to offset the demand in the PC and even some inventory adjustments. So so this basically a look through some company that's, for example, like Intel or even AMD, heavily on the PC side. I'm not sure about NVIDIA, because so here's the difficult about NVIDIA. So if you're looking at NVIDIA segments, right, there's 5 different segments from a big breakdown, but one major segment is the cloud data center. And then another segment is the PC gaming, and then you have the automobile and stuff. But the growth rate in terms of CAGR wise, right, we have the DCI projection. It's around like 50% ish, and for data center, and then for the gaming portion, even for the hardware portion, it's very low, high single digit, maybe 10%, 11%. So I'm not sure how this is going to read through in terms of TSMC to NVIDIA, in terms of how they're going to report their quarter, because they're in different type of revenue structure there. So this is a puzzle that I think we'll be able to solve when they release earnings. I mean, you could dive into how their channel sales compare, but I think that will involve a lot of bottom up assumptions that might up just making up numbers here. But I think that's interesting. And then last thing I would say is I mentioned, so one of the company I mentioned before is Alphabet, right? So I was telling you Alphabet search train is picking up a little bit. It's one of the only company that is not really getting the benefit of this FOMO melt up or whatever you want to call it for the past quarters. So there is a indicator that's used by Bank of America as advertising indicator. Is their proprietary indicators to tracking the advertisement and for companies in the online ads sector. So it's actually been improving month over month, which is good to see. I think that's why you've seen some read-through in Meta, some read-through in even some social media company like Snap or Pinterest. But I think Google is definitely kind of, if this is true, I mean, in terms of to read through, I mean, Google is definitely will also enjoy fund this type of pickup in the advertising segment, and it's actually second half. I think recovery in search trend will also be interesting for management to comment on, and then not to mention their LM model, right? So the Bird platform also picking up steam compared to ChatGPT. ChatGPT is not just the only LM model there, right? There's so much LM model out there. ChatGPT is just one that people are talking about. So yeah, so I think that's just some interesting point that I've been saying. Yeah.
Yeah, Monliv had made the point earlier that over the next couple of weeks from Microsoft and Google and I guess Apple, like if they're not showing a path to real revenue recognition from AI, that then perhaps the market has gotten it wrong and front ran revenue too quickly. If there's a lot of hardware costs that they're going to incur to build out the ability to generate that revenue in years 2, 3, 4, whatever. I mean, obviously the Microsoft announcement on the $30 a month per head for Office got quite the reaction. But when is that revenue going to come in, and how much cost are they going to incur to support that revenue base before it gets there? I don't know. It's not my area of expertise. So, Mondev, I don't know if you want to add anything to kind of respond to some of what Steve had to say in that.
Yeah, I'll pass on Google. If I say something and I get caught, I'll be in trouble. So I have a restriction on that. So I'll pass on specifics of Google. But for anybody that's run this much of companies the size of Google, Meta, and Microsoft, I think they have to show visibility of that revenue rather quickly. Doesn't have to be next quarter, but it has to be significant enough and coming in fast enough that run is justified. We're talking $1 trillion in case of Microsoft. That's it's not normal to get $1 trillion additional market cap. If your revenue is out 6 months, 9 months, maybe that's justifiable. If you can say, what, we are bumping our growth projections for years out from low teens to high teens or even above, then yeah, it starts making a heck of a lot of sense, and then you can start revaluing all these companies up. But if they come and say we are going to be spending to build out capability, and we expect to see revenues starting next year and growing and things like that, that basically means that it's a small addition to revenue and a large addition to cost that in the near term, and we are still looking forward more than a year out before we see inflection. In which case, given the uncertainties, in the macro, maybe they've run too fast. So that balance, I think, comes from reading very carefully the words they pick for their for their guidance. And I certainly think it was no accident why Microsoft released that pricing for Office when they did this week. It's not without a plan to deviate some of the attention, because they're going to talk a lot about it. They're going to talk about the TAM, right, which is basically their 385 million Office subscribers and what conversion rates they are hoping to get and all that. But again, that's a deflection, right? So I want to see when the actual numbers show, and I think that is going to determine what the valuation should be. Again, I'm not unfairly picking on Microsoft. I unfortunately cannot talk about the others.
But one thing I also want to add, I forgot to answer when talking about NVIDIA, for their gaming segment. So I remember I mentioned this. So they released their new GPU last month, which is the RXC 4060 and the 406 Ti, which is their technically the upgrade version of the RST 3060, which is one of the mainstream gaming GPU. And then I have to say, I've been talking to some, doing some channel check, talking to some gamers, and checking some data on the stream website. It seems like people are, I mean, at least when I'm checking it, the people are not very, I would say, I wouldn't use the word happy, but they're just not very buying the new GPU upgrade, because um, I mean, I'm not going to get into that technical on GPU here, but basically they are more or less more expensive than the older version of what they have, but they not produce the similar output, or I would say, when I say producing a very high output compared to older versions. So so people are not really seeing the value of their buying this new upgrade version, especially one of the core strength in GPU is the memory space. It's still they're still clocking eight gigabytes. So versus the 16 gigabyte they had it on 30 60. So I would be interesting to see how Jensen Huang is going to comment on their sales, the release on their GPU release. Just doesn't seem it's quite well received in the gaming community. Obviously, we're gonna have to see more data to see what actually happens. And just keep in mind, AMD is releasing their own higher end GPU second half this year. So anyway, it's gonna be an interesting space to see.
So Steve, there's a lot of chatter about AMD. They've already released, some of the tooling. They've already, started talking to advanced customers to get the first set in, late Q3. So they're going to get it out probably Q1 before we get numbers in enough volume to make a difference. But the problem is, as of last week, NVIDIA is already taking orders into late May. So any impact from competition is literally going to be a Q3 problem for Nvidia. It's not, they are sold out almost all of Q2 already. So this is not this is good for AMD, but not yet, right? It's still far away. how much of the capex is already locked up in this. So I'm not too enthusiastic on the uh, market condition when AMD does release. I'll be very surprised if it beats their estimates, because there's a lot of people that have already committed to buying Nvidia. Or I mean, it's we're talking already into end of Q2.
Yeah, I agree with you. Like I said before, like you can see the read-through from TSMC where they're seeing a lot of headwind on PCs, right? And then so the AMD data center cell is a very small portion of the overall in terms of their CPU and then other hardware. So yeah, so definitely Nvidia have a bigger share in the data center. So that would you know make them more competitive in this space. But my point is for Nvidia is that um, I think people are anticipating this new GPU release will ramp up their gaming sales. Uh, but I just don't know how people are gonna receive when actual data come out, especially given the recent strength in the market share that people are anticipating good news, right? So usually when people are anticipating something,
The consumer side, I'm not sure. I think it's going to continue to stay weak for a little bit. Probably longer than people expect. Across the board in China, you can see that from all the integrators and suppliers, things are pretty weak on the consumer side of it, right? And we've already seen PC sales fall off the cliff. But staying for a second, the the other play that's run less than Nvidia, of course, is Broadcom. They are the networking suppliers for the GPU clusters that you have to build. So they are also the silicon supplier for the custom supplier for Google's TPU. So I think I think if there is a bigger upside, it is possibly in Broadcom, and also their VMware acquisition should close. And Hawktan is really good at squeezing out costs very quickly. So you're going to see a massive cost cutting measures in place for VMware. You know, within a few quarters of their close, you should start seeing the impact of that. So I'm actually among the large semis uh, with headroom to run. I like Broadcom.
yeah, Broadcom is an interesting company, and for sure, it's a little market cap is quite high on the in the upper end. But yeah, I mean, there's another company called the also kind of our peer play or probably in the space and AI space is called Marvell Technology, and they I think they're also a very key beneficiary in the themes in terms of data center demand. In terms of like generative AI, multi-year demands for like custom silicon and refresh rates. So like versus like 2 years versus like 4 year prior. So like shorting the gap there. So it's very important for like networking solutions. But anyway,
Marvel has Marvel is making the custom silicon for Amazon. They just won that order. I think early this Q2. But they've not announced any big wins. I do like Marvel. I have a position that I started in Q1. I like it. I'm keeping it. But you're right. They have data center exposure, in networking exposure, and custom silicon. But I think you'll see that Broadcom is the bigger winner after if in this build out. I'm just talking in AI in general terms. Is you're going to see a lot of money flowing into Broadcom's networking to build out the GPU cluster capacity.
Yep, we shall see. I think like in terms theme wise, like in terms sector rotation, if we're actually getting a sector rotation, I think just looking at, we're seeing people are focusing on from like a hardware like chip manufacturer to software related names like AI software, like for example, like Datadog or HubSpot, stuff like that. It's been picking up strength. I'm just interested in seeing those rotation going back and forth. But anyway, I would be interesting to see how I mean, we're pretty far away from NVIDIA quarter, so if I have some new data, we'll definitely check back on that.
All right, 10-minute warning. I'm gonna wrap after the 2-hour mark at the top of the hour. So, good discussion, guys. I mean, I appreciate that you guys know a hell of a lot more about that space than I do. I always enjoy hearing about what's going on there. Hopefully, folks enjoyed some of the freight discussion and touching on the AMC situation and BBBYQ situations. Jiro, let me bring you back up, and then yeah, if anyone wanted to kind of get a final word in before we kind of start the weekend up. I mentioned it at the beginning when there was only a handful of us in here. We'll be moving forward with publishing our PLBYDD report in a matter of hours. We're talking dozens of hours, but sometime over the weekend. So on Monday, we'll have a conversation about it if you guys check it out. And yeah, we'll talk about it more on Monday. We have a book club on Tuesday at 8 to talk about mastering the market cycle. And we'll be back Wednesday with the open mic, and of course next Friday back here. But I'll pause there. Jiro, you're back. Would you like to chime in? Final words?
No, I just have a quick and super basic question actually for Monative. Because when people say that NVIDIA is priced at 40 times sales, right? So, okay, I understand. How to say? I understand where they're coming from, and then there's this reasoning. Yeah, so you need to wait 40 years in order to get your money back. Is there also another measurement, that also accounts for that a growth company will, of course, sales will also grow over the period, right? So, is there how do you say? Is there another indicator which kind of describes a better ratio? Because 40 times sales is okay, it sounds crazy, but it assumes that sales stays the same for the next 40 years, which is
yeah, but is that a
ridiculous.
trailing sales view, or because I saw people talking
Yeah.
about the trailing numbers, and it's kind of stupid to even refer to the last 12-month numbers on a company like
Yeah,
NVIDIA in this
exactly.
situation, right?
Exactly. So I was just wondering, do actually industry experts use another indicator in order to create a growth factor or something, and then maybe that kind of ratio is then only, I don't know, like 20 times forward sales or whatever. Is there something like this, Rod or Monative?
It's there's look, industry wise there are lots of issues. There are lots of metrics that growth company investors use, but just going back to Nvidia, we're talking about massive margin expansion, while they're cannibalizing sales of other products, probably because they're going to have much fewer sales of lower end GPUs, to be able to stuff the market with this. But you're talking about like a good few, maybe a couple of thousand basis points higher margin on these products for the next 5 quarters. So you're gonna see massive margin expansion. You're going to see revenue expansion within the data center market, right? So data center last year, right, even if you stick to times sales, data center last year was just under 4 billion. This year is probably going to be north of 8 billion, and next year it's expected to double again. So it is not a small growth in just one division we're talking about. So like Rod said, backward looking calculation, it's really meaningless when you have this hockey stick growth. but I'll point you to some folks on Twitter that actually track on a weekly, monthly basis growth companies and the measures they use. You can take a look from them. Much better at it than I am. For me, it's much simpler process that I use. Plus, I just take the data from them anyway. So I'd rather give them the credit for providing all that data, so than take credit for it. But hey, Rob, I was just going to say, 2.5 million block order in AMC for 765. So market on close probably.
Oof! Wow.
I just bought
Yeah, look, I
some.
mean, it's just silly. Well, I don't want to say silly. It's just market dynamics, right? As we discussed earlier, you have an extraordinarily high borrow. You have an outcome to a court case that was not priced in, and this is the byproduct of people having to unwind their positions. So, I mean, right? It means nothing in the multi-year, from a fundamental investment perspective. But as we all know, supply and demand is really what matters in the short run. So there's a lot of demand for AMC shares here in the after-hour session.
Well, I'm sure whoever buying those shares are going to see the new what's the Barbie movie and was it Oppenheimer? You're
Yeah,
lining
I
up.
just bought some shares. I'm gonna see Oppenheimer.
You see a lot of the controversies about the dimension, right? You have to see it at 70 millimeter.
What I had seen, just to stay on the theater, if folks recall, there had been an initiative that AMC had pursued to try and upcharge for kind of center row, kind of premier seating in the theater. And I haven't dug into the reception. I only saw the headline was that has not gone well, and I think they're going to go away from that.
They're just gonna make the front row seats recline more, so that you can see the screen better. I don't know how
But they
well
were
that's gonna
trying to
work
charge
out.
more for kind of premier seating, and it doesn't seem like consumers are willing to pay for that.
Yeah,
Is what
that
I'm getting
program
at.
is stopped, but they're gonna try to like make the front row seats just like tilt back more, so that you can see the screen better. But it's still kind of nuts up in the front.
All right. Anyone have any last thoughts they want to share before we kick off the weekend, or before you go into a different spaces? All right. Not seeing any mics get unmuted. Then Mondative, Jiro, Chris, Steve. Thank you as always for chiming in.
Thank you.
Appreciate it. As I mentioned, we'll have a lot of programming coming out in the next few days. We look forward to hearing your feedback. And we'll be back Tuesday night for our next book club. If you want to discuss Howard Marks' Mastering the Market Cycle, please join us at 8 Eastern. We'll have a 2-hour discussion. We'll be back at 7 Eastern on Wednesday night for the market open mic on my personal account at Rod Alsman. And then next Friday, we'll be back here with our Wook and Review. So everybody enjoy your weekend. Stay safe out there. And if you're going out in the sun, be sure to put some sunscreen on.
Yep.
It's
Hey,
hot.
Rod, as always, thanks for doing these. It's perfect time to do, the Wednesday and the Friday market on close, spaces. Again, this is much more level-headed, informative than the usual whatever you call it space that happens. But also a small plug. I'll be doing my weekly earnings space at 2 p.m. Pacific time on Sunday. So I will send that out. Do join. Thanks.
Yes, definitely Monadiv's space, if you're free on Sunday, is worth checking out. And thank you for that, Monadiv. I mean, look, I know it's just the nature of things that hyperbolic stuff is a lot more engaging. We understand that, but just not my style. Much prefer having a discussion on fundamental things and things that are happening in reality, less of the speculation talk. To the extent that we have folks who have insights and expertise into a sector, I think that's more valuable for people to try and learn and get more competent and knowledgeable broadly. So yeah, we'll kind of keep in that vein. And sure, we do have an intention of coming out with a series that's a little more adversarial, that kind of welcomes a little more debate between bulls and bears on single names. So we'll see how that goes. But that wouldn't be a replacement. That would be incremental. So again, thank you very much for that, Monative, and definitely check out Monative Spaces. And yeah, we'll be back soon. And I hope folks check out the report that'll be coming out over the weekend. Look forward to seeing the reception there. So thanks everyone again for your interest in the discussion, and we'll talk soon. Cheers, everyone.